Hello, class. This is a recording for problem 1-13B. Hold on just a minute as I share the screen with you. All right, you should be able to see your screen now. I'm going to go over with you problem 1-1B, which has to do with analyzing transactions. So I'll move my screen over just a little bit so you can see the full version of the screen here. And we're going to analyze these transactions one at a time. Before we get started analyzing the transactions, what I want you to do is I want you to make sure that you read the instruction properly, because they tell you a lot of times information about the problem that is going to be important to you. So in this problem, we're going to be Amy Austin, and we're establishing an insurance agency. That means we're going to start the business from scratch on March the 1st of the current year, and we're going to complete all the transactions for the period of time in March. So we're going to start from the beginning of March and we're going to go to the end of March. We are, in the first transaction, going to open a business bank account with a deposit of $50,000 from personal funds. To do that, we're going to put it through the accounting equation. If you can remember from our previous recording, we talked about the elements of the accounting equation being assets, liabilities, and owner's equity. It's important to me that you know the definitions of these elements of the accounting equation and also know some examples of assets. Examples of assets are cash, accounts receivable, and supplies. Supplies is what we refer to as a prepaid expense, and as we discussed in our previous recording, prepaid expenses are expenses that we have purchased ahead of time that are recorded by our business as assets to start with, and once they become used, we will record the used portion in the expense section, but we cannot record them as expenses until we have used them. So when we first buy supplies, we're going to put it in the supplies account, which is an asset account. And over time, we're going to use the supplies up, and once they be used, we will call them an expense. So asset examples are cash, accounts receivable. You'll remember accounts receivable was the account that we use for recording transactions, revenue types of transactions where we haven't received the cash for those transactions yet. And so accounts receivable is considered to be an asset. All receivables are assets. All prepaid expenses are assets. Some other examples of prepaid expenses that we talked about were prepaid insurance, and sometimes we can have prepaid rent. But in this situation, our assets that we're going to be working with are cash, accounts receivable, and supplies. All of these meet the definition of an asset, which is something of value that the business owns. Our liabilities example that we will be using in this chapter or in this problem will be accounts payable. And accounts payable is a liability account, which means you owe an amount to a creditor. The items that will affect owner's equity are the owner's investment, which we're going to record in the owner's capital account in this problem. The revenue is going to be recorded in what we call fees earned in this problem. Your expenses are all recorded separately as expense accounts. And the drawing account is another word that we use for withdrawals of the business. You might remember that we said that owner's equity is made up of transactions where an owner can put their personal money into the business. We'll call that an investment. Investments add to owner's equity. Revenue is the amount of money that we're earning in the business. It's money that we earn because we have performed some type of service or revenue for the customer. And so revenue will also add to owner's equity. Your expenses will end up decreasing the owner's equity because they decrease the worth of the owner. And your withdrawals, or your drawing account, as it sometimes is referred to, is where the owners takes money out of the business to use for their personal purposes. So these are all of the accounts that we have within this particular problem. And all you're going to do is, when you look at each one of the transactions, you're going to pick out the parts of the transaction and put them into these different types of accounts. I guess I should tell you the definition of an account is just a place where we record increases and decreases. So when you hear me refer to cash as an account, I just mean it's a place, a record, where we're going to record increases and decreases. All of these different items here that affect the owner's equity are considered to be accounts where we're going to record increases and decreases. When we analyze a business transaction, we look for at least two parts. So when we start with transaction A, it says that we opened a business bank account with a deposit of $50,000 from personal funds. Since this is a brand new business, the owner has made an investment in this business by taking money from their personal account and putting it into the business. We only record transactions for the business, so we're looking at this from the business point of view. The owner's personal transactions are just for the owners themselves, and so the business is not responsible for recording those transactions, but they're only responsible for recording the transactions that affect the particular business. When we're starting a business, we have to have cash or some type of assets to start the business with. In this case, the owner is giving the business $50,000 to get started. So our cash is going to increase by $50,000. So we simply record cash under the asset accounts, which means that the assets have increased in this situation by $50,000. Since there always has to be two parts to the transaction, the second part of the transaction would affect owner's equity. Since the owner is making an investment in the company, the owner's equity or the owner's worth is going to go up. So our owner has just made a personal investment of $50,000. Their worth in the business right now is $50,000. In every transaction, your assets, your total of your assets, the left side of the accounting equation has to equal the right side, which is the total of your liabilities, which we sometimes refer to as creditor equity, or the total of your owner's equity, or maybe I should have said and the owner's equity. Liabilities and owner's equity make up the left side of the accounting equation. Owner's equity is made up of the owner's investments, they're made up of revenue, they're made up of expenses and drawing. All of these affect the owner's equity. But in that first transaction, the owner just made an investment, so the owner's worth has increased to $50,000. Because our owner's equity was affected and our assets were affected by $50,000 each, we are in balance. There were no liabilities that were affected in this first transaction. In the second transaction, we are buying supplies on account. Anytime we buy an asset, we are going to record it for the cost of that asset. So if we had bought something like buildings or land, the buildings or land might have a higher value than what we actually purchased the amount of the land or building for. Or the opposite could happen. The land or the buildings could have a lower value than what we actually paid for it. But we always record our assets at cost. It's something that we call the historical cost concept, and we use that to record our assets. And since supplies is an asset, we're going to record the amount of the supplies in the supplies account. And the amount of that supplies is going to be $4,000. In other words, our supplies is increasing because we bought supplies. Our company now has more supplies than we had before this transaction. And we want to reflect that. Now, your supplies is an example of a prepaid expense because supplies, we're expecting that we're going to be using up over time. But when we purchase the supplies, we always purchase it at the cost of the supplies, and we record it at the cost of the supplies when they are purchased in the asset account called supplies. So supplies is increasing in the B transaction, whereas my accounts payable will also be affected because we are buying the supplies and we did not pay cash for them. We know that we bought them on credit. When you see the words on account, sometimes it'll signal to you that it's accounts payable that we're talking about here. So we actually owe $4,000 to our creditors now. Our accounts payable, our liabilities, or amounts that we owe have gone up. And so we're going to record it in the liability section. So this B transaction has two parts. Supplies increased as assets on the left side of the accounting equation, and liabilities have increased as accounts payable on the right side of the accounting equation. In the B transaction, we're in balance because our assets are still equal to our liabilities. In this next part, they have us balancing after the two of these transactions. So what we mean by balance, BAL stands for balance, is that we're going to combine the transactions together to figure out what the ending amount of the balance is. At this particular time, our cash has a balance of $50,000 because we hadn't spent any, but we have that in our checking account, and we have $50,000 in order to spend on our operations for our business. We also have some supplies for our business of $4,000. The total of our assets is $54,000. Our liabilities on the other side of the accounting equation are $4,000. We had no liabilities that were affected in transaction A, but in B, we created the liability for $4,000. So when we combine these two together, we're going to get $4,000. My capital was increased in the A transaction, but we didn't do anything to it in the B transaction. So the balance is still $50,000. You might have noticed down in the bottom corner here, there's a place where you can check your work. I would suggest you use check your work quite often because you want to make sure that all of your amounts are correct. And since we're doing some adding and subtracting in this particular problem, it's always good to know that we're on the right track. So if you want to use check my work, feel free to do that. You just click on it. And when you see the green arrows, you know that you've done it correctly. If you see a red X, then of course you've done it wrong, and you'll want to correct that because if you do a transaction wrong early on in the problem, it's going to affect the entire problem, and we don't want that to happen to you. So if you'll check your work, that'll be something good for you to do. Also, if you start on a problem, you might have noticed the problems are kind of lengthy. So if you need a break and you want to stop and you want to come back to this problem later, you can do that. But what you're going to need to do is click on Save and Exit down in the bottom portion, right-hand corner of your work. Do not click on submit assignment until you're ready to submit the entire assignment. In your assignments, I usually have you doing 2 problems. So this is just the first problem that we're working on. You'd want to do both problems, and once you get through with them, submit them. You might also notice down at the bottom here that it's keeping score of what we've done already. We've got a score right now of 31.47%. And so I don't want to submit my assignment now. I want to save and exit it if I needed to get up and take a break, and then I could come back to this and Cengage will save it for me. But if you submit the assignment, you can't go back and start from where you left off again. You have to start completely over again. Sometimes that's aggravating. So what I would suggest you do is just get into practice to save and exit and not submit the assignment until you're fully ready to submit all of your assignment, which would be both of the problems together. So we're ready to analyze transaction C. And in transaction C, it tells us that we have paid creditors on account for $2,300. Anytime you see the word paid, you'll know that you've used some of your cash. When you're using cash, you're decreasing the cash. So you're paying out your creditor. You're paying them $2,300. So I'm going to put $2,300 in as a decrease to my cash account. That's one part of the transaction. And every transaction has to have at least 2 parts. So I need another part to this transaction. I get that through reading my transactions. So since this says that we paid creditors on account, they've given us a hint here. First of all, we know it's a creditor. So creditors, you should signal that with liabilities. And account also might signal to you that it's a liability. But be careful of that because there's also accounts receivable, which is an asset, and that's on the opposite side of this. Accounts receivable has nothing to do with creditors. Accounts receivable has to do with your customers. When customers owe you money, it's accounts receivable. But when your company owes a creditor money, it's accounts payable. So in this situation, we're paying our creditors. We're reducing the amount that we had established earlier as $4,000. We're reducing the amount by $2,300. And so my assets have decreased and my liabilities have decreased. The left side of my accounting equation went down by $2,300. The right side went down by $2,300. We're in balance. You should balance after each transaction. I'm going to check my work just to make sure we've done it right. And then we're going to go on to our balances. Now, after the transaction C, you can see that our cash has been reduced. You might notice up in Cengage, they give you a calculator that you can use. They also give you an ebook. I had a student that emailed me and wanted to know about an ebook, where you find the ebook. Well, a lot of times Cengage has them built right into the problems. So if you want to click on that, it'll take you directly to your ebook. But I also have it set a link set up in Blackboard under assignments. So if you'll go to the menu assignments and scroll all the way down the page, almost down to the end, not quite to the end, but almost down to the end, it'll say something about a reader for ACC 120 with Warren, I think it's Reeve and DeCock as the authors. There's a link there you can click on it, and that'll take you also to your textbooks. If you want to read the textbook, you can. Either way, it'll get you there. In this problem, they have a show me how. So you can click on that if you got lost on one of your transactions, and it'll show you how. Sometimes they have this feature built into your problem. Sometimes they don't. But in these beginning problems, they most likely will. Now, if you want to use a calculator, they have one built in for you, and I use those a lot when I'm presenting to you. So we're getting back to recording the balances after transaction C. If we had $50,000 in cash and we spent $2,300 of that cash, what we have is a remaining balance here of $47,700. I didn't do anything to accounts receivable, so I'm going to skip over here to supplies. Notice supplies was not affected, so you just bring the balance down. But my liabilities were affected. The balance before this transaction was $4,000. I'm going to deduct $2,300 from that because we paid our creditors $2,300. We still owe them $1,700, which is reflected in our liabilities now on our books. But we only owe $1,700 now because we paid off $2,300 of that $4,000 that we originally owed. You're going to bring down your capital because you didn't do anything to it. The investment amount is still the same. The capital amount is still the same. And we haven't created anything else that affected any of these other sides. Again, the total of your assets should equal the total of your liabilities plus your owner's equity. So this plus this should equal this plus this. The total assets must equal total liabilities and owner's equity after every transaction. Check your work just to make sure that it does balance out, and we're good to go to transaction D. So let's look and see what happened on transaction D. It says that we received cash. That tells us exactly what happened there to the cash. We're getting some cash because we have received cash in the amount of $13,800. I'm going to record that under my cash account. But then you want to analyze it further and say, well, why did I receive that cash? And it tells you in this transaction, you received cash from fees earned on the insurance commissions. Fees earned is our revenue account. Revenue will increase our owner's equity. So I'm going to go to the owner's equity side. I'm going to look for revenue. The only revenue account I have is fees earned. And I'm going to go all the way down to where it's on transaction D. And I'm going to place $13,800 there. And what this means is, since this was an insurance business, that they have performed a service, they've done some commissions, they've earned some commissions, and that's revenue to this company. Check your work. All right, now what you need to do is rebalance the account because we're on the balance part of this. So we're going to put into our calculator what we had in cash before the transaction, which was $47,700. Because we added the fees earned to that cash amount, we received cash, in other words. The total amount of cash that we have now is $61,500. We didn't do anything to accounts receivable. We're going to bring our supplies down because this transaction did not affect supplies at all. We're going to bring down our accounts payable. It was unaffected. We still have $50,000 as an investment by the owner, but our fees earned has grown to $13,800. That's the balance of fees earned right now. Check your work and move on to the next transaction. The next transaction is the E transaction. And in E, it says we paid rent. We paid rent on the office and the equipment for the month of $5,000. So our cash is decreasing. because it tells us that we paid cash. We paid for the rent. See the word paid there. That means that our cash went down by the amount that we paid, which was $5,000. We also paid rent, and it was rent. Evidently, we rented the office space, and some equipment we also rented too. But the best answer for that was rent expense. And when you are recording your expenses, you've got to record them as a decrease, because expenses will decrease owner's equity. We may have to tweak that a little bit in the next chapter, but in this chapter, when you're putting things through the accounting equation, you're showing that rent expense decreases owner's equity. Remember from the previous recording, your owner's equity is affected negatively by expenses. So this expense is decreasing owner's equity by $5,000. This transaction has two parts to it. Every transaction has to have at least two parts to it. And I'll click on check my work to make sure that your transactions are correct. Our cash balance before this transaction was $61,500. We have spent $5,000. So the remaining balance is $56,500. Our supplies was unaffected. Our accounts payable was unaffected. Our investment was unaffected. Our fees earned has a total now of $13,800, and our rent expense has a total of $5,000. We're ready to analyze transaction F. So for transaction F, it says that we paid automobile expenses. That's plural, so we had two types of expenses that we have to pay for. Now, when you're recording your expenses, you record expenses separately for each type of expense, because the owner would be interested in knowing how much his expenses were for certain expense items. At the end of the month, we're going to tally up those expenses to see what the total amount of the expenses are, because those expenses will affect the owner's equity negatively. So in transaction F, we are paying automobile expenses of $1,150 plus we're paying some miscellaneous expenses of $300. The total of those expenses is $1,450. Since we paid them, our cash is going to decrease. So our cash is going to decrease by $1,450. So we're putting the cash under the cash account because that's where it belongs with the assets. We're showing a decrease in our cash, and we're showing that our owner's equity also decreased by the amount of the automobile expense and the miscellaneous expense. So automobile expense, let me move my calculator out of the way so you can see what we're doing. Automobile expense is $1,150, and my miscellaneous expense was $300. Notice we're recording minus signs in front of those because these expenses will decrease owner's equity. Check your work. And we're going to rebalance our account. So we're going to start with our cash account at $56,500. We're going to subtract $1,450 from that, and that will give you $55,050. Bring down your transactions as they are. If there was nothing that affected them, you just bring down the previous balances. Then check your work. Okay, we'll turn that off for just a minute so we can see what we're doing. We're getting ready to analyze transaction G. And in transaction G, we're simply paying our office salaries. So again, the word paid means that cash is decreasing. It's going to decrease by $2,500. And it was office salaries that we're paying for $2,500. So we're going to go to salary expense. We're going to go all the way down to the G transaction. And we're going to put in a minus $2,500 there too, because we're decreasing our equity. Check your work and move on to the next transaction. Our cash balance was $55,050. We're going to subtract out $2,500. We have a remaining cash balance of $52,550. All right, our next transaction is going to be H. And H is a little bit different. With H, it says that we are determining the cost of the supplies on hand. That was $2,700. We determined that. So we determined this sort of toward the end of March. A lot of times we'll take a physical count of our supplies to see what we have left over. When we see what we have left over, that will help us to determine what was used. In other words, we bought supplies in transaction B, and at the end of the month, we had taken inventory to see how much we used. What we found out when we took the inventory was that we had $2,700 still left over in supplies. So therefore, we used $1,300. In other words, $4,000 minus $2,700 will leave you with $1,300 that has become expense during this period of time. What we want to show is that the balance in the supplies account is no longer $4,000 because we know that we've used a portion of that supplies. We want to show how much it's gone down by. The amount that it's gone down by is $1,300. So my supplies is going to be decreasing by $1,300. at the same time, because my supplies, which was an asset, is used up, my supplies expense is going to be affected. My supplies expense will actually be increasing, but expenses overall will decrease owner's equity. What we're showing in this accounting equation is how owner's equity is affected. So by using up $1,300 of supplies, it affected our owner's equity negatively because our supplies expense was affected. Our owner's equity was affected negatively because expenses decrease owner's equity. So this is an example of where we have what we refer to as an adjusting entry. We'll be talking about adjusting entries in a later chapter. But early on, this is one of the first adjusting entries that we're going to be analyzing, which is to determine how much of your prepaid expenses have been used at the end of the period of time, so that we can show that the used portion is what will go into the supplies account. Now I'm noticing I got a red X here, so I might need to look back and see what happened here. Did you see that I put it in the wrong column? I should have been in supplies. So let me put in a negative 1,300 over here in supplies, and let me get rid of this to the salary expense. This was not a salary expense. This had to do with supplies. So let me get it in the right column to start with. Then we can rebalance our transactions like we were doing before. Since we didn't do anything to cash here, we just bring down the cash balance at $52,550. Our supplies did decrease. It decreased by $1,300. What you should always have left in the supplies, which is the asset account, is the unused portion. So you'll remember that we had supplies of $4,000 before this transaction. When we counted our supplies, we determined that we used 1,300 of those. So we're going to deduct 1,300 from those supplies, and that will leave us with a balance in the supplies at 2,700, which matches our physical count of our supplies in that transaction. All right, so our next balance was 1,700. We didn't do anything to that in transaction A, so we're just bringing it down. Bring down your balances. Then we'll move on to the next transaction. So for I, it says that we have billed insurance companies for sales commissions earned. This is a transaction that sometimes gets students. So if you get this one wrong, don't feel bad, because a lot of students miss this one. But I want to emphasize to you that the word billed here means that we're sending an invoice to our customers. If we're sending an invoice to our customers, they have not paid us cash at this time. They're going to pay us cash later on. So when you see the word billed, it will signal to you that you're sending an invoice to our customers. That invoice is going to become a part of your accounts receivable. we would create an invoice when we have earned revenue. Because we have the right to collect from our customers, then we're going to record that billed portion or the invoice portion in the accounts receivable. The accounts receivable has increased by 12,500. So when we increase our accounts receivable, we're making sure that our assets are going up in this situation. The other portion of that transaction is that we need to record that we've earned some more fees, we've earned some more commissions, sales commissions earned or fees earned, or what we refer to as revenue. So in our revenue account, which would affect our owner's equity account, we're going to put down the amount of $12,500. It's going to increase our revenue, which will increase our owner's equity. Now we're going to rebalance this transaction. Just bringing down the amounts. And we need to determine how much total revenue we have there. Before the transaction, we had 13,800. We're going to add to it 12,500. And that's going to be a total amount of 26,300. Finish balance in your accounts. Just bringing down what we had earlier. And then we're ready to complete J. In J, it says we withdrew cash for personal use. Anytime the owner takes money out of the business, when they withdraw cash, we put it in what is called a drawing account. The key terms here is it was for personal use. When we record our transactions, our owner's personal transactions have to be kept separate from those of the business. We're only recording what's happening from the business standpoint. So in this case, our cash is decreasing by $3,900. So we're going to show that under our cash account as a decrease. And every transaction has to have at least two parts. So in this transaction, our second part is going to be for Amy Austin, who is our owner's drawing account. So the drawing also is going to decrease owner's equity. Drawing is not exactly going down here, but the fact that the total drawing for the period of time is going to decrease our owner's equity. They're just looking at this accounting equation and how it affects owner's equity. So drawing decreases owner's equity. And we'll check our work. And then we're going to rebalance to find our final balances. All right. And that's all there is to it. When you're analyzing transactions, this is the way we analyze transactions. What we really can tell from these transactions is that at the beginning, we had no business at all. By the end, we had all of these accounts that we had created for the month of March. At the end of March, these are the amounts that we have in each one of these accounts. And again, account is just a place where we record increases and decreases. We record all business transactions in accounts. I want you to really learn the business transactions that we've gone over today. The second part of this problem has some what if analysis. But this major part here is the most important part that you can learn today. The rest of this we're going to be learning in the future, but I do want to talk to you a little bit about that today. And I'm going to show you how to finish up this problem, so at least you'll be finished with one of your problems for your homework assignment. It says, which of the following increased owner's equity? Now think about the things that affect owner's equity. You'll remember from the last recording we said that the owner's investment will increase the owner's worth. The revenue that you earn in your business will also increase the owner's worth or the owner's equity. Your expenses will decrease the owner's equity, and your drawing will decrease the owner's equity or your withdrawals. So if we're looking for increases, we know they have to be the transactions that affected our revenue and the transactions that have affected our owner's investment. So what I want you to do is select the best answer here. And when you're paying rent, your expenses would decrease owner's equity, but they wouldn't increase owner's equity. Does that make sense to you? If you paid creditors, your cash is going down, which is an asset, and your liabilities are going down. There's no owner's equity at all that is affected. If you receive cash from fees earned, then fees earned is revenue, and revenue increases owner's equity. So this one is correct. If you opened a business bank account with a deposit of personal funds, the cash would go up, but the cash goes up because the owner made a personal investment. So C and D are the best answers. So in this case, it would be E is the one that I would select. They also want you to determine net income. So if you'll hold on just a second, I've created an Excel spreadsheet for you to show you how to get net income. So hold on just a second. I'm going to share another part of my screen with you. And what I've done is I've copied the ending balances from that problem that we were talking about before. These were the balances after the last transaction. These were the balances for March. To determine net income, you need to know the total amount of the revenue for that period of time. So the ending balance and fees earned is the total of the revenue. There was only one type of revenue that this company had, and they were calling it fees earned. So $26,300 is your revenue. You're going to list all of your expenses separately on the income statement. Remember, management would be interested in where their money went and how they spent their earnings. And so rent expense and salary expense and supplies and automobile expense and miscellaneous expense are all expenses that this company had. These amounts came from the ending balance. So rent expense, salary expense, supplies expense, and let me get me out of the way here, and automobile expense, miscellaneous expense. That's where I'm getting all of this information right here. You're going to want to total your expenses. When we add up all of our expenses for the month of March, we get 10,250. To determine net income, you're simply going to take the total of your expenses from the total of your revenue, and that will leave you with the net income. Net income is an amount that will affect your owner's equity as positive. Remember that at the end of the period, we're going to combine all this information together, and so we can summarize it. So from this information on the income statement, we've recorded all of our revenues and all of our expenses. We've summarized those to report a net income, which is also known as a net profit for this company. So this company was profitable for the month of March. But what could have happened is our expenses could have been larger than our revenue. If your expenses are larger than the revenue that you've earned for that period of time, you will have what is called a net loss. A net loss will decrease your owner's equity or the owner's worth in the business. But in this situation, we had net income. In the next part of the problem, they ask you about determining an increase in owner's equity. So what I've done is I've just shown you a little statement that we're going to talk more about the next time that we meet, which is called the Statement of Owner's Equity. On the Statement of Owner's Equity, we find all the things that affect owner's equity. You've already learned that investments affect owner's equity, and revenue and expenses and drawing affects owner's equity. So they're just reported again in the form of a statement. And in this statement, we just write down what we know. But notice when we are determining our owner's equity, we're going to start with the beginning owner's equity, which we sometimes call capital. And that beginning owner's equity for this month would be on March the 1st. Remember, we didn't have a business in February. So we started this business at the beginning of March. There was no owner's equity at the beginning of March. But by the end of March, we had all these accounts going on. And so our owner's equity most likely was affected. And we're just showing that in the Statement of Owner's Equity. You'll always add your owner's investment. Remember, owner's investments increase owner's equity. The amount of the owner's investment for this period was $50,000. That came from the ending balance in your capital account. We're going to add the net income to it because the net income was a combination of revenues and expenses. Our net income amount was positive. It added to the owner's equity. So we're going to add our net income, and then we're going to subtract out our drawing. Our drawing is the owner's withdrawals, and that was $3,900 that came from here that I plugged in here. The difference between net income and drawing will give us the increase in owner's equity for the period. It's not the total owner's equity, but the increase is actually this. So the beginning owner's equity for this month was $0, but the owner contributed $50,000 to this business. So the owner's worth increased by $50,000. Then we had net income, which further added to that owner's investment, and it came up to, or excuse me, we had net income, and then we deducted our drawing. The increase was $12,150, we combine all of these together to get the ending amount of owner's equity. So what does this tell us, class? It tells us that we started with no owner's equity, and by the end of that period, we had grown by 62,150. So our ending owner's equity really increased in this period of time to 62,150. I'm going to stop here because I'm sure that I've given you enough information to overwhelm you probably today. It was not my intention to do that, but sometimes accounting can do that. But we're going to stop here and rest a while, and then we'll come back again on another video to show you some financial statements. So we've got a good handle on things that are happening within this chapter. Go ahead and finish reading your chapter. And once you do, I'm going to take you back to Cengage for just a minute, if I can find it again. That was it. Well, there it is, right there in front of me. Okay, taking you back to Cengage here, and then the net income to finish this problem was the amount of $16,050. That's what we had on the Excel worksheet. And then we're going to show that this owner's equity increased to 62,150. Okay, check your work. And then you'll notice that I have a score of 50%. The reason I have a score of 50% is I only did one of my problems. I have two problems. So I would save and exit here. So you'll have this recorded, and then I'd probably take a break and then go on and try problem 1-2A. But save and exit will keep your information there. Once it's submitted, it's gone. It doesn't mean you can't redo the problem. You can, but you have to start over from scratch. And I don't want that to happen to you. So again, this is all I want to talk to you about today. We'll see you again the next time that we meet. So we'll stop sharing this with you, and I'm going to end our meeting today. See you later. Bye-bye.